Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday the 17th of October 2019 and we're continuing with our theme this week of just talking about silver. In this video podcast we're going to break some myths about the gold to silver ratio, highlight how relevant it is and what conclusions can we draw from this much heralded calculation. So let's investigate. Ever since this channel began, and before, much has been made of the gold to silver ratio, especially supporting silver pumpers who have used this calculation to suggest that silver is on the verge of a major price breakout. They have frequently called this because the gold to silver ratio has been rising over the years, and there have been one or two occasions when percentage-wise silver has either caught up or almost caught up. But we thought today we should examine this calculation a little more closely. As we produce this video, the price of gold in US dollar terms stand at $1,487 and silver at $17.31, suggesting a ratio of just shy of 86 to 1. So firstly, let's take a look at an article published way back in 2014 by Global Banking and Finance Review. Now, to confirm the point that we are making concerning the gold to silver ratio, I'd like to draw your attention to an article in Global Banking and Finance Review. Now, this was back on the 9th of April 2014. And this was at a time when the gold to silver ratio was hovering between 70 and 75 to 1. This is what the person said initially to introduce it and then the conclusion of his article. The gold to silver ratio, which is a measure used by many precious metal investors to determine the relative value of the metals, has been used for years. In fact, the relative value of the two metals can be traced all the way back to Roman times, during which time the ratio fluctuated between 12 to 1 and 12.5 to 1. Shortly after the United States gained its independence from Great Britain, a fixed gold to silver ratio of 15 to 1 was passed into law. Now, this is why you hear the pumpers so often say 15 to 1. While the price of gold remained fixed in the United States until Nixon severed ties to the gold standard in 1971. The gold to silver ratio continued to fluctuate during this time, as the price of silver was, and still is today, determined in the commodities market. While the gold to silver ratio hasn't been as low as 17 to 1 since 1980, many investors believe that we will eventually see a return to this ratio, or possibly even lower, and are investing accordingly. Remember, this is back in 2014. In this article, we'll explore if the gold to silver ratios from 1792 and 1980 are relevant today, and if investors should rely on these ratios when investing in precious metals. 1980. When silver investors make reference to historical gold to silver ratios ranging from 15 to 1 to 17 to 1, they oftentimes point to 1980, when for a brief period of time the ratio was 17 to 1. More specifically, gold and silver reached levels of $850 and $50 respectively. However, what many individuals fail to realize is that the silver market at that time was being manipulated by the Hunt brothers. They sought to corner the silver market and in doing so caused the price of silver to skyrocket up to $50 an ounce. COMEX responded by changing their margin requirements. Furthermore, the Federal Reserve increased interest rates in an attempt to choke off inflation, which caused the price of silver to subsequently spiral to $4.98 an ounce 30 months later, which was just 10% of the peak reached in 1980. I think perhaps he should have said spiral down. Considering that the price of silver was being manipulated in 1980, we don't believe that the gold to silver ratio of 17 to 1, briefly reached in 1980, is a good benchmark. Rather, investors should pay more attention to average ratios established over a period of time, such as the 47 to 1 ratio experienced in the 20th century. Another good benchmark to consider is the 31 to 1 ratio we reached in April of 2011, when silver peaked at $50 an ounce. In this author's opinion, these ratios are more relevant than the ratios established in 1792 or those briefly reached in 1980. Now, even at 31 or 47 to 1, that would truly bump the price of silver up compared to gold today. But what the author is saying is ignore these 17 to 1, 15 to 1. Let's continue. As with any other commodity, the price of gold and silver is determined by supply and demand. According to this piece from zerohedge.com, some of you will recognize that, gold to silver production is approximately 10.7 to 1. Furthermore, due to the fact that silver is utilized quite extensively for industrial purposes, almost half of all silver ever mined has been used or lost. Considering that most gold mined throughout its history is still in existence, the current ratio of available silver to gold is 5 to 1. Based on the available supply of silver, you would expect for the gold to silver ratio to be much closer to the fixed ratio established in 1792 or briefly seen in 1980. However, it's important to remember that the price of gold and silver is determined by different factors, which we'll discuss next. While a record number of American silver eagles were sold in 2013 at slightly less than 43 million ounces, the fact remains that investment demand for silver is much less than for gold. According to the following article from goldnews.com, investment demand for silver in 2012 accounted for approximately 15% of the use of silver compared to 44% for industrial usage. Now, of course, if we bring that up to today, the industrial use has ranged between 50 and 60%, but the amount of silver for investment purposes is also proportionately considerably lower. On the other end of the spectrum, approximately 40% of gold is used for investment purposes and only 10% for industrial uses. Not surprisingly, jewellery accounts for approximately 50% of the use of gold. Now, these figures are slightly out, but they're not hugely out. Bearing in mind this was written in 2014. We're using this article because it actually exemplifies our argument why you shouldn't rely necessarily on the gold-silver ratio. Another factor affecting the price of gold is demand by central banks, who have been net buyers of gold over the past couple of years. This has helped to establish an artificial floor in the price of gold, as central banks tend to buy on dips. Central banks, at least at the time of this article, do not purchase and store silver. Let me read that again. Central banks, at least at the time of this article, and as far as we are concerned even today, do not purchase and store silver. Now, I know some of you say, oh, JP Morgan have tons of silver in their vaults. Well, first of all, they're not a central bank. And then we can argue over why they're holding that, whether it's for clients or their own account, but that's another matter. Because different factors affect the price of gold and silver, they won't necessarily move in tandem. Nor is there a known catalyst that will substantially shrink the ratio. And this point in 2014 is just as relevant as it is today. Or is just as relevant today as it was then. Unless investment demand for silver dramatically increases from its current levels, or we experience high levels of inflation, or see a huge increase in the demand for silver for industrial purposes, we would expect for there to be a healthy spread in the price of the two metals, which at the time of this writing is 66 to 1. Summary. While many investors often refer to the historic gold to silver ratio of 16 to 1, the fact is that the US has not had a fixed gold to silver ratio for many years. Furthermore, the last time the gold to silver ratio reached these levels was in 1980, which shouldn't be used as a benchmark, as the silver market was being manipulated by the Hunt brothers at the time. For two metals to remain at consistent ratios, there must be a relatively constant supply and demand. While silver is consistently produced at levels approximately 11 times that of gold, demand and use of the two metals varies quite substantially. In other words, the demand indicates the price as opposed to the level of supply, which does have a bearing, of course it does. But it comes back to what we have said many times before. You have apples and pears, and there are more apples in the world than there are pears. But the price of apples are not proportionately that lower in price than the price of pears. Now, unless investment demand for silver substantially increases from its current levels, or if we experience economic conditions that are bullish for silver, we expect for the historical ratios of gold and silver to remain just that, a thing of the past. In other words, don't necessarily rely on historical ratios when determining when to purchase gold or silver. And this article, and you may be surprised at this, is written by Tony Davis, the owner of Atlanta Gold and Coin Buyers, a full-service Atlanta-based coin and bullion dealer. So, what this article, this author is saying, is that to a large extent, except in extreme circumstances, you can certainly forget a gold to silver ratio of 17 to 1, 11 to 1, 16 to 1, 5 to 1. Even at this time, it was closer to 70 to 1 or 66 to 1. And it has averaged much higher since. Now, that does not mean that if the gold to silver ratio tomorrow spiked to 120, that maybe even we would think, this might actually be worth an exchange. But over time, that ratio has been slowly rising. And it's central banks buying gold. Gold being the first two place to go for safety, security, hedging purposes. And silver lags gold. Even Keith Neumeyer, one of the most, what I would call, extreme silver bulls, even Keith Neumeyer admits silver lags gold. Where we would differ with Keith is that it won't necessarily overtake it. It has done, but it's more rare than common. The main two messages we draw from this article are, 1, because different factors affect the price of gold and silver, they won't necessarily move in tandem, nor is there a known catalyst that will substantially shrink the ratio. And 2, unless investment demand for silver dramatically increases from its current levels, or we experience high levels of inflation, or see a huge increase in the demand for silver for industrial purposes, we would expect for there to be a healthy spread in the price of the two metals, which, at the time of this writing of the article, was 66 to 1, but today stands at 86 to 1. Now, let's briefly talk about our favourite subject, silver and gold pumpers. This is what they will argue, and we have seen recent videos, even now, arguing this case. But we're going to use our current gold and silver price to express the examples that they've given in those videos. In 1980, the gold to silver ratio was 17 to 1. If that happened today, silver would be $14.87 divided by 17 equals $87 an ounce. Silver comes out of the ground at 7 to 1 compared with gold, so today's silver should be $148.7 divided by 7, $212 an ounce. Available silver to gold, because much of silver is used and discarded, is 5 to 1. So the price should be $14.87 divided by 5, $297 an ounce. Can you not see what a tremendous bargain silver is at $17 an ounce? And these arguments are constantly used to encourage us to buy silver. Now, just out of interest, they rarely mention the fact that the other way of achieving that ratio is to reduce the price of gold. So, with silver standing at $17.31 at this moment, a 17 to 1 ratio would suggest that gold, instead of being $1,487, would be $294. At 7 to 1, it would be $121, and at 5 to 1, it would be $87. Now, admittedly, none of us believe that gold will ever go that low again, even though it has been as low as $103 in the last 45 years. At the higher gold to silver ratios, such as 60 or 70 to 1, there is a distinct possibility that gold could come down to make that ratio work. We doubt it, but it's a possibility. So let's just take a brief look at what the gold to silver ratio has in fact done recently, and how far back we have to go when it was as low as 17 to 1. So let's take a look at the last 15 years, the gold to silver ratio. Now today, as we've said, is the 17th of October, and at the moment gold is now $14.90 and silver is $17.39. So it's moved ever so slightly since we started writing this video. Okay, so what does this graph tell us? Well, first of all, it's run by Bullion by Post, so we thank them for allowing us to use it. At its low, over the last 15 years, silver has been as low, the gold to silver ratio is 31.12 to 1. Now you may recognize the date. That was essentially when silver was at its peak. This is the $50 an ounce, almost $50 an ounce silver. So it's an extreme. Equally, up until that time, for the last previous few years, the extreme was 81. But look what's happening to the trend. Since that time, the trend has been consistently rising. Now, we're not advocating that we expect this trend to continue well up into the hundreds and 120s and so on. But why, if in the last certainly since 2011, it's been in a rising trend. But even if we go back to 2009, the highest level was 81. The lowest level was 46, 47, 48. Why should we ever think that silver would be 15 to 1? When at an extreme moment it was 30 to 1. Other moments previous to that, it was around 50 to 1. And more recently, it's been averaging, to be frank, between 70 and 90 to 1. Now, what we've done in our assessment for this year, we've said, okay, the most poignant part, because we've had quite a few dips, then rises, lower dips, then rises, then we had quite a big dip here, and then every dip thereafter has been higher than the previous dips, you may notice, until this point here, but that was a slightly extreme rise there. We can't draw a line on this chart, otherwise we would put a line in and we would show a trend line. But that apart, we made our assessment when we gave our forecast for this year for the price of gold and silver. We basically stated through our calculations that the worst case scenario by the end of the year, if all things go wrong and silver gets a huge leap, that a 65-to-1 ratio is the best that silver is going to do compared to gold. And with gold, if we base that now similarly on today's figure, I think at the time we were basing it on $1,500 gold when we did it, but at $1,490 divided by 65, and we get a figure of $22.92 or $23. And you will notice that our extreme calculation for what the price of silver could be by the end of the year was $23. And that's one of the ways that we assess the price, by believing it would not go any lower than 65. Because prior to this figure, you do have to go back another two years. But there's nothing to indicate that that would happen. And of course, with gold being a leading indicator, suggested to us that if anything, the gap would get wider. So when people start talking about 15-to-1 silver, even if we look at a 20-year chart, there's still no 15-to-1. If we take a look at a 25-year chart, that low of 32 is still the low. If we take a look at a 30-year chart, it's still the low. If we take a look at the 35-year chart, that 30, some reason they've put it in at 31, but that is still the low. If we look at a 40-year chart, now, for the first time, we're going back to 1980, when it was as low as 17-to-1. Nearly 40 years ago, and this was at the time of the Hunt brothers' manipulation. So anyone who starts quoting 17-to-1 ratios until silver becomes ultra scarce, and that is, all the mines that have been opened have all dug out everything that they can, until that day happens, you are not going to see a ratio of 17-to-1, unless, of course, there is an enormous gold deposit found that equates to 10 times what's currently available on the earth, in which case the price of silver won't have gone up, but the price of gold will have collapsed, and then maybe you'll see a 17-to-1 ratio. Hope you find this useful. Finally, and we are aware this video is beginning to become lengthy, and for the sake of balance, we shall take a look at the argument in favour of assessing the gold to silver ratio. Here goes. So let's take another look at the gold to silver ratio. A different article, this time by Investopedia. And as you can see on the screen, it's entitled Trading the Gold to Silver Ratio by Caroline Banton. And this was updated October the 8th, only a few days ago, or a week. For the hard asset enthusiast, the gold to silver ratio is common parlance. For the average investor, it represents an arcane metric that is anything but well known. The fact is that a substantial profit potential exists in some established strategies that rely on this ratio. The gold to silver ratio represents the number of ounces of silver it takes to buy a single ounce of gold. Here's how investors benefit from this ratio. And these are the key takeaways. Investors use the gold to silver ratio to determine the relative value of silver to gold. Investors who anticipate where the ratio is going to move can make a profit even if the price of the two metals fall or rise. The gold to silver ratio used to be set by governments for monetary stability, but now of course fluctuates. And alternatives to trading the gold to silver ratio include futures, ETFs, options, pool accounts and bullion. So, in very simple terms, the gold to silver ratio refers to the ratio investors use to determine the relative value of silver to gold. Put simply, it's the quantity of silver in ounces needed to buy a single ounce of gold. Traders can use it to diversify the amount of precious metals they hold in their portfolio. Now, I won't go into an example because it's relatively obvious. If we actually look at the history, the gold to silver ratio has fluctuated in modern times and never remains the same. That's mainly due to the fact that the prices of these precious metals experiences wild swings on a regular daily basis. But before the 20th century, governments set the ratio as part of their monetary stability policies. Here's a quick overview of the history of this ratio. 2007, for the year, the gold to silver ratio averaged 51. 1991, when silver hit record lows, the ratio peaked at 100. 1980, at the time of the last great surge in gold and silver, the ratio stood at 17. End of the 19th century, the nearly universal fixed ratio of 15 came to a close with the end of the bimetallic era. Roman Empire, the ratio is set at 12. And 323 BC, the ratio stood at 12.5 upon the death of Alexander the Great. So, we have seen a move, depending how far back you wish to go. We could go back to 323 or the Roman Empire when it was 12 or 12.5. End of the 19th century, 15. 1980, 17. For 2007, 51. We heard earlier that the average of the last 5 years, 50. And when silver hit record lows, it peaked at 100. And we saw only a couple of months ago it hit 93, or just over, and is currently vacillating really in this 80 to 85 mark. Now, in fairness, this is where the gold to silver ratio can be quite important. Despite not having a fixed ratio, the gold to silver ratio is still a popular tool for precious metal traders. They can and still do use it to hedge their bets in both metals, taking a long position in one while keeping a short position in the other. So when the ratio is higher and investors believe it will drop along with the price of gold compared to silver, they may decide to buy silver and take a short position in the same amount of gold. So, this ratio is important for investors and traders if they can anticipate where the ratio is going to move. And this is the key, because investors can make a profit even if the price of the two metals fall or rise, depending on how that juxtaposition works out. Basically, the problem, though, with trading the gold-silver ratio is highlighted here. The difficulty with the trade is correctly identifying the extreme relative valuations between the metals. If the ratio hits 100 and an investor sells gold for silver, then the ratio continues to expand, hovering for the next 5 years between 120 and 150. The investor is stuck. A new trading precedent has apparently been set, and to trade back into gold during that period would mean a contraction in the investor's metal holdings. In this case, the investor could continue to add to their silver holdings and wait for a contraction in the ratio, but nothing is certain. I repeat that, nothing is certain. This is the essential risk for those trading the ratio. This example emphasizes the need to successfully monitor ratio changes over the short and mid-term to catch the more likely extremes as they emerge. An interesting article making the case for traders to use the ratio. But as in all things financial, let's be honest here, trading gold for silver is a gamble and vice versa. Now we would contend, once again, that whilst the gold to silver ratio is a useful tool, and particularly for day trading too, it is certainly not something you should necessarily depend upon. And most certainly in our view, unless an extreme circumstance occurs, ignore all of those people who claim that the ratio has to adjust to 1980 levels or worse to the ratio in which it comes out of the ground. They are usually bullion dealers or silver miners with a vested interest. With gold close to $1,500, it would make sense to assume silver, based on recent trends, will rest at or around 80 to 1 to 90 to 1. Or in a more extreme situation, could fall back to 65 to 1, thereby suggesting a price of between $16.60 at worst, or at the lowest, and $23 at best or the highest. Affected only then, depending on where the price of gold moves. Of course, these change depending which direction gold moves in. Hope you found that useful. It is admittedly only our opinion, but our own assessment too. It is based, we believe, on pretty good mathematics and underlying factors which we've not had time to go into here. But thank you for listening. And in case you haven't listened to our previous 2 videos on silver, the last one yesterday entitled Silver's Rocket Will Be Financial Not Physical, and the day before Silver Future Looks Bright But When, we have provided links to these and our 2019 forecasts for the price of gold and silver and the potential outlying limit, which suggests $23 silver, though we doubt it's going to achieve that in view of the geopolitical situation, but it's a potential. And we have provided those links in the description box below. And finally, if you haven't already done so, we would truly appreciate it if you subscribe to this channel and press the bell sign so that you are notified of future videos. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.